think I want to start with the Girl Scout cookies. But let me set it up first. First of all, thank you for being here. This is another roundtable to review mainstream pricing news. So just to set this up, if you haven't seen these videos before, the idea is to go through the big public pricing decisions that have been made with mostly large companies, with our pricing experts. So we'll go through each story that is happening in the news from the last couple of weeks, and then we'll go through ideas or lessons, anything that would be valuable for business leaders to take away from the biggest wins and losses from the last couple of weeks in pricing. So first up, this was from Yahoo Finance. So the Raspberry Rally Girl Scout cookie sold out fast and is now selling on eBay for 8 times the price. So this is $50 a box was the latest number that I saw, plus $10 for shipping for, I would say, the most disappointing part of the story, which is that the flavor is raspberry. That's what this is over.
Not the fact that the poor Girl Scouts didn't get the revenue from it.
Right. It's so disappointing.
That's great.
So the statement they made was they're disappointed, obviously, that it's like unauthorized resale. But the thing that I didn't know is this was their first time putting it online, like selling a cookie exclusively online that was only distributed through the Girl Scout Cookies website until it wasn't. So what's your takeaway from this whole thing?
Scarcity.
Yeah.
It's basically they're introducing something new. You can think, even Chick-fil-A not open on Sundays to some degree drives desire to make sure you buy it on Saturday if you care.
Right.
This is interesting because in essence, this is the Girl Scouts rolling out a new product. And when you look at new product pricing, you want to get a sense of what your demand is going to be. So they've done this in the past where they had new flavors. A couple of years ago, the s'mores flavor, and wasn't as much of a hit. But in this case, it seemed like the demand was an unknown, and the demand skyrocketed, and that therefore led to scarcity, which Pete mentioned. So yeah, the implication is that somebody else is making a bunch of money off of Girl Scout cookies as a result.
You know what? When I read the article first, or I read the news, it reminded me of Nike, and it reminded me of the aftermarket of the shoes, right? And it's just amazing how it happens. So it's good. The scarcity portion of it is 100%. This is what happens: supply, demand, all of that good stuff. So this is all we can see it with our eyes. But the secondary market is an interesting one. I was asking myself the question of, which products dictate opening up a secondary market. So we know with the shoes, there's a secondary market because they feel like you even if you can't get in on a Monday afternoon to buy it from Nike, you can wait till it hits the secondary and you could buy it at a premium of, let's say, 50%. But what made somebody go, Girl Scout cookies would be a good one for a secondary market? Or am I just that ignorant and people are testing these things all the time, of different products that are out there, and this one just caught fire and other ones that are being tested didn't? I'm not sure. Do you guys know if other products are being tested?
I mean, obviously, like tickets, right? That's kind of a scarce resource. Yeah. And then you think like even Beanie Babies 30 years ago, which is kind of like the dawn of eBay.
Yeah, that's right.
The Purple Princess Diana one was like going to take us all to retirement. It was like 10-year-olds.
Yeah, like it probably cyclically happens every year around Christmas. Like there's always the hot gift people hoard and then sell as like a drop shipper or secondary market. And maybe this is just Girl Scout cookies get released in the spring. Like this is just the time. And then like it's just, like there's always peak demand. It's seasonal. You can't really do it for McDonald's Shamrock Shakes because they melt. But if you could,
you can't afford that, Pete. It's too much of a capital expenditure to get a large freezer to hoard all the McDonald's. That's awesome. Yeah, it would be. I mean, you just went through a nice checklist of things that would dictate who would be ripe for a secondary market, or what products or solutions would be good for a secondary market. it is interesting. I wouldn't mind doing a little bit of research to figure that out a little bit more.
In what scenarios is it like, is this, I guess the secondary sneaker market, is it legal? In what scenarios is this okay?
Yeah, it's legal. I mean, you own the product. So if I buy a product, I own it. I can do whatever I want with it. You know, I could throw it in the garbage and I could sell it for $700. It's an efficient market. So if nobody buys it, nobody buys it. I mean, if somebody is willing to pay for it, they're willing to pay for it.
Yeah. So the Girl Scout cookies, it's really just a shame because the whole point of the cookies is to raise money for something. And it's a different thing. I get it. Okay.
Yeah. It's like they're missing out on a lot of revenue, right? It's for the betterment of the Girl Scouts, not,
Right.
you know, there is that notion of, you know, and we're going to probably talk about this a little bit more with the healthcare stuff, but there is a notion for what's good for society versus somebody trying to make a buck.
Right.
The Girl Scouts one is interesting though, because I mean, that's part of their brand is scarcity, meaning that, you know, you sell these things at a specific time of year that creates some hype and that therefore creates demand. What's going to be interesting about this specific one, I think, is what they're going to do next year in terms of supply for these raspberry cookies, meaning are they going to bet that this thing continues with the momentum that it has, or is it just kind of that one-time Beanie Baby type of a thing?
Yeah, it will be like if they try to stop this or from happening or try to do something, it could lead to a bigger deal than they want. You know what I mean? Like, you know, people are always trying to make a buck. So if they try to do something to even limit that, I have a feeling it's gonna, you know, it'll go viral.
Well, yeah, they'll bring attention to it. Because I even had a moment where I was like, all right, well, these cookies are that good. Maybe I should check this out. I don't even like raspberry. I was so offended by the whole things. I like the peanut butter ones. And if this was a peanut butter shortage, it would be a whole other conversation. The tag-alongs or the Thin Mints.
You would be willing to pay high premiums for those.
Would. I would not be happy about it, but I would. Let's move to the healthcare stuff. So this whole thing, well, I think the Inflation Reduction Act put a couple of things into play. So the first one that caught my eye from a pharmaceutical perspective was Eli Lilly. So they decreased the cost of insulin down to $35 a month as the cap. So that was like the first of what seems like maybe dominoes. It's hard because on one, like they're just kind of doing what they're supposed to do because of the Inflation Act, but at the same time, it's a good thing. So good on them. Novo Nordisk was the other one right after them. Same idea, dropping insulin prices. So what's your take on this one?
These ones are tougher. So we typically deal with companies in the B2B space. And our approach, as we've talked about in the past, is to align price to value. In the drug space, that's tougher because the question becomes, how do you define value, particularly in an environment where there's an element of public good associated with the product that you're selling. So that's where this concept that we've been talking about a lot, the concept of fairness comes into play, meaning that our goal is to always price in a way that is fair. In the drug market, that concept of fairness, these are life-saving drugs that people need. So if your price is at a point where it's perceived as being unfair, independent of the market, that's going to cause some friction. So I think this is seemingly a result of them putting the price point in a way at a place where it is fair for broader society. So, I think that societal good piece is playing a big role in this strategy, as well as perhaps some regulatory pressure.
Yeah, it's the age-old debate, right? Which is, do we let the market be efficient and work itself out, or do we influence the market? And these companies exist to make money, and they need to make money. They have the ability and the capability. If somebody goes in and says you can only make so much money, that's a slippery slope. All of a sudden, you're going to have other industries that people are going to start regulating and putting in there. So it's just, you have to be very, very careful here. I love the fact that some of these guys went to the $35, which was in the Inflation Reduction Act. So that even the number itself gives you a clue that they didn't really come up with a fair price. They didn't really come up with anything. They just said, oh, you're telling me there's a bill in there or something in there that, you know, stops me from going above it. So I'll just make that applicable for every segment and just charge 35 max, you know, so even that. And then not to mention the fact that they've already made so much money off of that one product already. You know, if you look at the lifetime profitability of insulin, there's a lot of companies that have already made a lot of money. So it's one of those things where I think the real question is, should there be government intervention? Should there be a different set of rules for companies for the common good of humanity? I think that really is the question that's on the table. Not to get too political about it, but I think there is some of that that's there.
Yeah, I think, gee, what you're saying, other than the fact that the fake tweet that Eli Lilly would offer it for free or, you know, whatever, like that was probably an anchor that prompted a little bit of action. And then, yeah, the Inflation Reduction Act. But, you know, in pricing, we say there's three things you can do with the price. You can either have a revenue maximizing price, you can have a profit maximizing price, or a share maximizing price. And then in a good like healthcare or pharmaceuticals, you know, which of those three should a company go around? I mean, certainly shareholders would probably mostly prefer there's a profit maximization strategy, which makes sense with what their interests are. And then the question is, should there be a different optimization point after a certain level, X number of years, you know, sort of why there's a patent. You get, you know, to recoup your investment in this technology by, you know, having a patent, being able to sell it for a high price. But at some point, if that comes off, should there be a deliberate nudge towards something that makes sure it gets distributed to everyone, not just the few that can afford it?
Yeah, it's very to me, the fake tweet was the interesting point, right? That you brought up. They said the fake tweet happened and their stock price tanked.
Yep.
So it goes to show you, like, if you say I'm going to give something away for free, my stock price tanks. That tells you the efficiency of the market or the focus of the market or the shareholders, right? Which is to make money. So if you're going to have these companies be in NASDAQ, be in the stock exchange, you have to expect them to make money. And if they don't, because they're doing something for the common good, they're not adhering to the first rule, which is shareholders' equity. You know, and so I think this is really interesting. And Pete, I like the direction of what you're saying, but what if it's a scenario where you can save lives of masses today? So even if the patent is there and you say, oh, only so if you can afford it, you can buy it for the first 2 years. After that, it'll be for everyone. For those 2 years, what if there was, you know, 2 million deaths? Then it doesn't make sense.
Yeah, exactly. So yeah, there's a way in which the government gets involved in that today, but you could have a pretty healthy debate on whether that optimization lever should be different even from day one.
Yeah,
or different set up a different way.
Yeah, and I was talking to a buddy of mine who used to run analytics for a large pharmaceutical, and he was saying that a lot of consumers, because prices go up so drastically and change so drastically, they skip meds, they cut meds in half to elongate it. So already these types of environments are creating situations that's not for the betterment of the health of the individual. It's to limit cost on the individual side while maximizing profits on the seller side, right? And it just, you know, it's a very sad situation. I think our system is broken inherently, and that needs to get addressed. But I think it goes beyond just pricing, is what I'm trying to say.
Yeah. All right, well, here's a different angle. So this was in the New York Times. The headline was, is the entire economy gentrifying? So the concept here that has shown up more, I would say, in the last couple of weeks is premiumization. So the trend is that companies are—
Say that really fast.
I know, premiumization. The idea is that companies are pushing the customers towards more expensive and more premium offerings, which includes WD-40 with a new can with a smart straw that sprays in 2 ways, Krispy Kreme donuts, which added a fourth pricing tier that includes handmade cinnamon rolls. And they also had, by the way, a different, this was like more campaign based, but Krispy Kreme, I found in this article, had this whole thing that was like, we will match the price of gas. So that was their whole thing, is that which I thought donuts were like 99 cents. So they just had a whole other thing going with that. But the idea of premiumization, I think, is the thing we want to focus on, is like, who is this for? Where is it useful, kind of thing.
Why do bank robbers rob banks? That's where the money is. So, I mean, that's really, I feel like that's kind of the net of this whole story, is that's where the income share is going, towards the top end of the economy, and companies want to play where there's more spending power.
I guess it's like, in these examples, it's with companies whose stuff is already cheap, right? So I was thinking about in our work, when we work with people on flanking products, right, where things are typically more expensive, right? And then the flanking products are the less expensive and less valuable offering, kind of keeps your customer with you, keeps them from leaving you for a cheaper thing. With this, is it more like people kind of leveling up when they're coming in at a lower?
I think that's right. I think what they're doing, when the term premiumization indicates that they are adding high value features to their existing products, right? So in the case of WD-40 or Krispy Kreme, they're testing or have identified items to say, how can we get our buyers to pay whatever it might be, 10% more, which, on a product that's $5 is only 50 cents more. But can we put this out there so we get a segment of buyers that we can better monetize, and that can drive a couple of percentage points to our bottom line? So I think you're seeing some experimentation on that front that offers customers choice at a slight premium versus what they're used to pay.
I think consumers always have had the habit of buying beyond their needs. And the concept of buying premium has always been there. I think it's a human nature where, if you look at like Mercedes and BMW, most of the purchasers are purchasing these things on lease, or they're buying it, with a 7-year, note on it, because they can't afford it. Yet they're trying to buy it because they want that brand. They want to show what they can afford. So the concept of premium in pretty much every consumer brand has been there. And now we're seeing that lower end, to your point, Tracy, trying to reach up and see if there's a market that's out there. And my guess is there will be a market out there, because they're tapping into something that's kind of inherent in humans, that marketers tap into all the time. And so I'm not surprised by it. I think what's interesting is it is, for me, I'm extrapolating a little farther down the road, where I do see a world as sort of access to data and information increases, our ability to analyze things increase, our ability to store information gets cheaper. With all of those things happening, I do see a world of sort of this bespoke, customized universe that's going to be around us, where we get to choose, what's premium, what do I need, what do I want, and how do I create this environment around me that everything is customized to me, and everything is sort of very much singular based or family based. That, I think, we are moving towards that type of a world, and this is just, I think, one half a step towards it.
The other one that I had next was TikTok and how they've monetized for creators. And I wasn't going to go there yet, but you're kind of making me think, like, so the idea is that you can start charging for your content, which, some of the content on TikTok, obviously a lot of it is much more playful and like kind of social media in its purest form. But then there's other things that are like more educational and ways to find really useful shortcuts on Excel or whatever. And I think there's a new thing that's going to open up just in terms of like quote unquote premium content and what's valuable to people. that will be, I don't know, coaching or kind of the next level of workouts. There's all kinds of stuff in terms of tutorials and education that I think will kind of converge with what you're saying.
Yeah, I think it's both sides of the equation, or actually there are three sides here. There's the content provider, which is leading to that world of the gig economy world, right? They get to work from anywhere. They get to present themselves as what their superpower is, right? Whatever they're good at. Now I can package that and sell that to a community that's out there, and I have a platform to be able to do that, which is awesome. And so that is one aspect of it. The other aspect is these social platforms that are out there like TikTok. They have to find different ways to monetize, right? Because they can't just hope that marketers are they're going to get marketing dollars and that's the only way they'll monetize. They have to reinvent themselves. So there's that aspect of it. And then there's that aspect of, the actual consumers of the information, which is, I want things that's very, very specific for me. To your point, Tracy, you were making, it's customized. And I love Tracy's workout videos because she is doing something that I really value. It's very sort of narrow, niche-y, and that's what I want, and that's what I'm going to go after. And these platforms are incredible to offer that level of specificity in what I want and need. I think it's fantastic.
Yeah, this play is really interesting. So, I mean, in the social media space, like you just said, where these platforms have to figure out a way to monetize their base, you think about kind of the history behind these things. And I think back to when Facebook announced that they were acquiring WhatsApp. The price tag was astronomical at that point. I think it was, I don't know, maybe close to 9 or 10 years ago. They paid like $16 billion for WhatsApp. And at the time, they were generating $10 million in revenue. So, I was working in corporate strategy at the time, looking at valuations and such, and it's just astronomical. But the way that they're basing these valuations, as many people know, is based on the number of users. So I think it was in the realm of like, I don't know, $40 per user, and that translates to that $16 billion. Point being, their valuations have always been around the number of users, and now it's coming to a point where they have to be able to monetize that user base while also making sure that they continue to add users. So making sure that content providers are getting paid for their work and users are coming in consuming that work is going to grow that base, grow their valuation. And, now they have to figure out a way to make money off of it. So we're going to see a lot of experimentation there.
Yeah, and contextualize, it kind of makes sense. You have a wide user base, it's probably advertising revenue at like a small amount per person. Then you have like the Cameo, which is custom content for an individual at like $20, $50, $100, $500 per person per video. And then this is kind of in the middle, where maybe everyone pays $5 more and they get something that's semi-customized or semi-better, but not to their name specifically.
One of the questions I was asking myself as I was reading the article was, with these social platforms, have they hit a theoretical maximum of what they can do to influence behavior out of the users? Meaning, we know that the platforms are set up in a way to change a user's behavior, to inform us of new products and services, to kind of push us to click on things and to try things. I'm wondering if they've kind of, from a marketing perspective, they've kind of plateaued. That's going to push them to monetize faster in other ways, because I can see also a little bit of a backlash from the community where we don't want to share our data as much. We don't want to be on TikTok as much. We don't want to be on Instagram as much. So I think from a user perspective, I wonder if there's a push to say, I spend way too much time on these platforms. I'm going to put a pause on it. Which then, of course, would hurt the marketing dollars that these platforms would make. And I'm wondering if this is another strategy that says, hey, we're going to go to the next tier here because we are seeing some slowdown on this side.
They announced a week or two ago that they had started to cap user hours for users under the age of 18. So I wonder if there's going to be more. Yeah, that's interesting. I just wonder if there's going to be a lot more in the mix with this too, kind of to your point.
Yeah.
All right, Twitter. So Twitter, this is from Wired, Twitter's $42,000 per month API prices out nearly everyone. So the idea of this whole thing, I learned this from reading this article. So academics mostly use free access to Twitter, to the API specifically, in order to access data on what kinds of things people are talking about and the conversations that are happening on the platform. So it helps people in their research understand what the online world is talking about. So it said since 2020, there have been more than 17,500 academic papers based on the platform's data, which kind of helps support Elon's whole thing about the town square. But he's now going to start charging for this API. So the cheapest, which is what this headline was about, is $42,000 a month for what's less than 1% of tweets. That's the whole idea of what's happening here. This is, I said the other day, like Twitter is just the gift that keeps on giving. Because this guy is so unpredictable, but he keeps doing unpredictable things, which is very predictable. So it's like, I never know what to do with myself when I'm reading this stuff. Like, will it stay? Is he going to pull back on it again? Like the other thing? I don't know.
I was just going to say really quick. Obviously he doesn't want anybody using it, and this is the way that he's without saying I'm shutting this down and nobody can use it. He's like, oh no, people can use it. They just have to pay for it, and you just charge a really ridiculous price that nobody is going to be able to afford, especially in the academic world where a lot of these things are really generating from. I mean, no one has money like that to burn in academia. So this is a strategy to essentially shut that API down.
Okay, but like, why? Just to make Twitter more inaccessible and more special, and you have to actually use it to, like, what does he care?
There's probably a bigger strategy that's in play over here with the data and the data monetization. So he's just I think he's just shutting down these corner cases that are out there that people use it for, to really hone in whatever his data strategy is.
Interesting.
Yeah, this one, it's interesting because like you said, it's very, very unpredictable. But often when I read about these Twitter moves, you read it and then you're like, you got to be kidding me, right? You're in a bit of shock because the prices are just so high. And there's that element of having to pay for something that was previously free. And I think the point in this one is that actual price point just seems incredibly egregious, particularly for those in the higher end market. But the other side of the coin is that there is actual value in that data to the researcher. It's just likely not worth, or the ability to pay $42,000 per month, right? $500,000 a year is too much. But, let's just say if it was a tenth of that, then is that a price point where this model could work? Because again, there is value. But to the point that you're making, Jeet, it is priced in such a way to either create headlines or lock some people out of the market so they can concentrate on the portion of the market that is viable. Or the other angle could be, hey, we're going to put this price point out there, and then we're going to cut it by 75% so people feel like they're getting a deal or something like that. So
right. Yeah,
I don't know exactly what
that's what I was going to say. It's kind of an anchor point. You don't know what their actual deals look like. It's a B2B transaction. So it could just be, for the buyers that can afford it, they'll try to hold the line. For people that don't, maybe they give 90% discounts. You just don't know how it's going to actually play out.
It's a bit of a joke.
It is. It certainly is. Overall, okay, so there was news yesterday about inflation rates that continue to be high, but are leveling out a little bit. The article that I was looking at, this was in NPR maybe 2 weeks ago, says, despite high inflation, Americans are spending like crazy, and it's kind of puzzling. Which also, by the way, reminds me of the other big article that was like, why is the recession always 6 months away?
Yeah.
So it's like, it's constantly almost about to be here. So maybe we just talk about the recession more broadly as it relates to inflation. Like, how does this all play out in the next 6 months or 1 year? And how should people think about it?
Well, I can start. I think there are portions of the market that we're already in a recessionary market where it's shrinking. But I think all these, prices going up, prices going down, all of these things, I think people forget that there's still a little bit of pent up demand from COVID that's there. People didn't have the ability to buy cars because of shortages. So there's like pent up demand from there. So we're going to see some of those things trickle through as time goes forward. So just because the demand is there for certain goods and services doesn't mean, demand is altogether really high or altogether really low. It's just there. And I can give you examples like around here in Arizona, as our hourly rate went from like 11, 12 bucks an hour to like 15 bucks an hour. So people are getting paid considerably more for some of the work that they're doing, which is great, but they're able to spend it. So there's some pent up, savings from COVID. There's higher wages. People are spending that money, and we're seeing that money being spent in consumer goods, like always. So there's a lot of factors that are coming in here. Travel is strong because people didn't travel for the last 2 years, and we have a very large population base, meaning, you're not going to see everybody travel in 1 month. You're going to see that trickle over a longer period of time. So to kind of pick and choose the data points and then make a market determination of what's happening, I think might be a little egregious. I don't think we need to do that quite yet.
I think it's that plus, $5 trillion of stimulus was pumped into the economy. Some of that was spent right away. I think a lot of it is still sitting on the sidelines.
Mm-hmm. Yeah, that savings is huge, especially when you give that money in, like PPP loans and things like that, and you don't expect that money to come back to you. So there are a lot of companies that just kind of put that into savings. A lot of companies used it for other things. So there's a lot of cash in the system, basically, to its point, that still exists.
Yeah, and I think that low unemployment is a sign of that, right? People have jobs and have the ability to go out there and spend money. So I don't know. I don't find it terribly surprising that people are continuing to spend money, given some of the things that we just talked about.
And with the high interest rates, it's kind of a delayed effect. You're not quite sure when it's going to happen. And just with the Silicon Valley Bank this week collapsing, there could be maybe other banks will be shored up by the action that were taken, the rescue of the account holders. But there's probably some lagged effects that from the higher interest rates that maybe will come out later in the year, and so those are kind of all delayed. People aren't moving because they have a great mortgage, but at some point they'll get a new job or they'll want to be in a different place, and then you'll be forced to sell at a price that's lower and buy at a financing rate that's higher.
Yeah, absolutely. And in all honesty, like the rates aren't egregious if we talk about home buying.
Historically, no.
Historically, it's not egregious. And then there's always the opportunity to buy down, and then there's always an opportunity to refinance. So I think some of this information or news that gets put out there, I think at times is meant for shock, and it's meant for headlines rather than reality of what's actually happening.
So from a planning perspective, or maybe more like strategy perspective for B2B, it's more looking at the cost and the demand and how that varies between or within products, I guess, right?
Right, within the markets. That's our 2x2 or our framework that we use. Because it's tough to have a client who has typically many markets and many products going into many markets to say, oh, everything is in a recession or everything has high demand. That's really, that's impossible almost in any year, not just this year. This year just makes it a little bit more difficult because there is a lot of volatility. So you just have to really figure out where you are with these combinations of products and markets and what your strategy should be. And that should be our guidance in a B2B world.
All right. Maybe that's it. Is there anything I missed from the last couple of weeks? Valley Bank was a big one.
Yeah, that one's a big one. That one's, I don't know, for me, I have a hard time with it, just knowing that they took such a risk to take startup dollars and invest it in startups. There's something inherently just not right about that.
It's really only a pricing problem in that bond prices and interest rates move in opposite directions. But other than that, we don't get too involved in it.
And they were on the wrong side of both bets, right? So
Yeah.
Man. All right. Well, that's our rundown from the last couple of weeks. Thank you.
Thank you. Appreciate it.
All right.
Bye.
Till next time.